One of the questions that we get asked all the time is how do you value early stage companies at a seed stage before there's revenue? I'm David Gowdy and I'm managing partner at Jungle Ventures, and we typically invest in Series A and B stage companies, but I'm here to talk a little bit about how you would value a seed stage business. As businesses get larger, you can usually have metrics to look at that will help drive a view of valuation. And a lot of times, as the companies scale, you can use comparable metrics. So you can look at public companies and see how they're priced from a multiple basis, so either on a profit multiple or a revenue multiple. But a lot of times, those businesses are a much larger scale because they're public companies. But at least it's a guide as companies grow to think about what could the company be valued at in the future, and then that you can use in today's valuation. But at a seed stage, when there's no revenue and very few metrics, and a lot of times it's just an idea or a PowerPoint where a team's just coming together to get formed, there's no real metrics or comparables to look at. And so typically valuation comes down to a negotiation between the founders and the investors. And typically, from a founder perspective, it's a question of how much capital do I need to raise in order to get to my first milestones, and then how much dilution am I willing to give away in order to get that capital. And then the other side of that coin, from an investor's perspective, is how much am I willing to invest in this idea or this team, and then what kind of ownership do I think is fair for that level of investment. And that really comes down to a negotiation. I think there are a couple of rules to think about as you go into that. One is that you don't want to price the business too high. And so in a seed stage, in the very first round, if you price the business at, say, $10 million, and you raise enough capital to give yourselves 9 or 12 months of runway to get to a certain level of maturity, if you haven't gotten to that level of maturity that would then price above $10 million, then you're actually going to be in what's called a down round. And so your second round of capital could actually be a lower price than $10 million. And that puts the business in a very difficult position to be in. And so as you think about valuation, you should also be thinking about where will my business be, how much runway does this give me, and where will my business be at that stage, and what's a fair valuation in the next subsequent round. And I think that can form a good opinion on where you should be coming out with this round. Lots of times founders also will opt for convertible notes. Safe notes became very popular, and that's a means of getting capital in the door without actually having to set the price. There's typically a cap and a discount in notes, and so there is some sense of value because there is a cap. But then if the round price is at a lower number than the cap, then the investors just enjoy the discount. If the price is above, then they enjoy some upside gains. And obviously, since a lot of this comes down to a negotiation between the investors and the founders, equipping yourself with information about the market in which you're operating in will really pay dividends to you in thinking about the fair and just price. Because a lot of times what investors are thinking about is where can this business go, how big can it be, and is this the team that can execute that business plan? And so having a good sense of the overall market potential, your role in the market, how the business model is going to come together, the team that you need to assemble, what that cost is, how long of a runway this amount of capital is going to give you. Being well defined in terms of thinking through all of those and presenting those in a very coherent way, I think will set you up for a very strong negotiation with investors and hopefully bring on the best investors that you possibly can. So in summary, as you think about funding and valuation an early stage company, it really comes down to collecting as much information as you can and being able to present that in a very well-refined way to potential investors. It's understanding the amount of capital that you really want to raise, the runway that that's going to give you, and then the dilution that you're willing to take for that. And also, a third point is making sure that that valuation is not too high, that it disrupts where you will price in your next round. We're thinking about alternative ways to bring the money in, like a safe note, where you can defer some of the pricing off into a future date. I hope what we went through today was a little bit helpful. If it was, make sure you click like and make sure you click subscribe and give us your feedback and tell us whether or not you think this video was interesting or if there's other questions that you have that you'd like us to answer.